Hi, welcome back to We Hate Insurance. So we're going to talk a little bit about life insurance today. How much is too much? So many times people come to my office and they're like, I want to get insurance, life insurance, but I don't want to talk about it. I don't want to go over how much I actually need. I just want a simple answer from you. How much should a guy like me have, or a gal like me? So often those questions are complicated because there's a lot of factors that go into play. We as agents try and make it simple for you, and we've got a few tricks and tools to do that. One thing you don't want to get caught up in is the idea that having money in the bank or assets on the ground is enough for your heirs. One expense that we're all going to have is final expense. And if you have anybody in the world that you love or any organization that you love, you need life insurance. If you owe anybody, you need life insurance. If you don't owe anybody and you don't love anybody, sure, whatever you got in the bank, that's fine. The funeral home can wait, right? But if you have heirs, those heirs are going to be responsible for paying your final expenses at the very minimum. And those final expenses have to be paid before probate is settled, before Uncle Sam takes his part, before anything passes from your estate to your heirs. And that process can be pretty complicated and complex and can take a year, 2 years sometimes. And so it is much more viable uh, for you to have at least final expense life insurance that's going to take that worry off of your heirs' plate and put it into their hands right away. Because a life insurance contract is settled directly with the beneficiary, not with the government. The government doesn't get any taxes off of it in general. They do not get to say where it goes. It is a contractual obligation from the life insurance company to your beneficiary that you have named, or that the owner of the policy is named, which is some complexities there. But for the simple stuff, we're talking about a final expense policy. Um, at the very minimum, that's what you need, and that should be a permanent policy. And we'll talk a little bit about that real quick. It's going to be a brief video, so we're not going to get too deep in the weeds, but I'm going to show you a couple of things. How much life insurance is too much? Let's say you do have some debt, you do have some folks that you love, and that you want to make sure that they have the resources they need to carry on in a lifestyle that is at the bare minimum what you've got going on today. There is a very simple acronym that a lot of life insurance sales folks, agents, they'll talk about, and it is called LIFE. L stands for liabilities. That's what you owe. So this is part of the equation where you write down how much you owe. Now, if you're a two-income family and you have, your spouse has a good job just like you, and you share those bills equally, then maybe that's half. Maybe your part of it's half. But that's up to you. You know, removing the burden of that liability is one way to make life easier for your heirs once you're gone. So however you do that, you talk it out with your agent, what makes sense to you. If you guys both share the bills equally, you share the income equally, it comes in equal terms, or maybe one of you has a better job than the other, you might want to make that, you responsible for more debt or them responsible for more debt. However that works out, it's a conversation. But the one thing that L in that equation, that acronym, means liabilities. That's what you owe. So that's a part of it. Maybe you don't want to pay any of it off. Maybe you make a lot less than your spouse, and your spouse can afford it and carries most of the debt anyway. And you're like, I'm done. Put a zero there. It's pretty easy. Number two is income. Yeah. How much income would you want to replace? How much of your income is important for the operation of the household? And if you don't have an income, what is what's your value in terms of income? So let's say you have one spouse that works and one that stays home with the kids. Childcare is expensive. latchkey service is expensive, and transportation costs are expensive. So if something happens to the spouse who is, taking care of the kids, that's going to be in kind um, effort equal to a certain level of income that you're going to lose. So, let's just say childcare is $10 an hour, or let's say it's $5 an hour. Let's make it cheap. $5 an hour, 40 hours a week, that's $200, right? Is that right? Yeah. 40 hours times $5, that's $200 a week, which works out to $800 a month. That's on the really cheap side. If you find somebody that's going to do it for $5 an hour, that's really good. But then you have transportation, and if you don't get off work and they're a school age child, or they're preschool or whatever, after 6, the rates go up. No matter how low they are during the day, they're going to go up. So you got to take that into account. So transportation costs, lost work, lost wages, plus the cost of childcare, you're at the very minimum, bare minimum. It's going to be about $1,000, and that's for one child, and probably quite a bit more than that, probably double that. So you just multiply that times 2 or 3 years, because that's what you're going to want. You're going to want a little bit of time to make up that income that's going to be lost, so that you can take care of the kids, have them on a schedule, and you can continue to work to make that bigger income that's going to take. So even at that, you're looking at 50, 60, $70,000 just at the bare minimum that they bring to the table over a 4 or 5 year period. More than that, you can figure other things that they do. So that second one is income. How much of your income do you need to replace so that your family can maintain their lifestyle? And if you don't bring an income in, what do you do that would have to be replaced, and use that as a basis for income? So those are the first two. What do you owe? What do you make? And number 3 is the final expense. What do you want? I know people that want, the whole shebang. They want a crypt, a casket. They want silver lining. They want the flowers, the mourners, the everything. You're talking $30,000 for a funeral. If that's important to you, if that is the traditions that your family has, then you should do that, and you should plan for it. And instead of making everybody just pull it out of thin air, you should build it into your plan, your final expense plan, or your insurance plan. And this part of it should really be permanent. It should be permanent life insurance, because debts go away. Your income that needs to be replaced may be mitigated once you retire, because you'll have investments. All those things change, but your final expense does not change. That will be around forever until you die, right? So you may want that, instead of that big, elaborate plan, you might want very simple. You might want to be cremated and just have a simple funeral. It could be 10,000 or less. Whatever it is, plan for it, and know that you might be planning for something that's not going to take place for 30 years or maybe even longer. So final expense, again, that's a conversation you got to have with your agent. Make sure that you got a local agent, somebody that knows you, knows your family, and knows what's important to you. So, what do you owe? What do you make? What's going to take to put you in the ground? And then finally, E. So, LIFE. The E is for education or endowment. When your kids are younger, you might want to help them with their school. School's expensive. And after they get out of high school, are they going to go to college? If they go to college or a trade school, how are they going to pay for that? Some parents are like, no, they're going to pay for it on their own. They don't value it if they don't. Okay, then put a 0 there. Or they're going to be like, no, I want to make sure that they've got that opportunity. I want them to make sure that they've got money that they can rely on to get that education, so they can get that good job, and they can have a good future. Okay, great. Take what kind of university you think that they're going to want to go to. It's kind of hard to tell when they're 3 years old, but if they're older, then you can talk to them. What do they want to be? Where do they want to go? Hit a ballpark amount. Don't put too much thought into it. Just take 4 years or 2 years or whatever the schooling is, the current cost of it, add 10%, and boom, go. Put it on there. That's that is something that if it's important to you, it's important to you. If it's not, it's not. The other thing is, once your kids are older, everybody's been through school, what do you want to do? You might want to give an endowment. You might want to make sure that NPR has got funding. Recently, funding's been cut for that from the federal government. So a lot of people that donate to that are increasing their donations because they think it's important. So your final expense, your final hoo-yah, you might be able to leave them some money. How much would be enough? How much will get your name on the board? Maybe the animal shelters, the local animal, no-kill animal shelter is a really important thing to you. You want to make sure that continues. Maybe your church is important to you. Maybe you want to make sure that there's an endowment to your church so that they can build a new school or that they can take care of some missionaries that are in the field currently. Well, that's a personal thing. Talk it over with your agent. Then put it all on paper. How much your debt's going to be paid off? How much your income do you want to replace? How much do you want to spend on your final expenses? And what is this endowment or this educational amount? And then you put it out in the universe and you come up with a number. Oh, one important thing, this could be a pretty big number, but you might want to subtract any current interest that you have. If you have a policy through work, you can subtract that from it. Maybe you got 100,000 through work and you're like, oh, I don't need $400,000. I only need 300. But that's how you figure out how much you need. And then you can work with your agent to figure out how to structure that. Anything that's debt or perhaps the income replacement, those are going to change over time. You won't always have that debt, and your income may be substituted for investments or annuities that you get in retirement. So those will go away eventually, or they'll reduce, or they'll change just somehow. Final expense won't change, and endowment, that's not going to change. If you want to leave something to your church, don't put it in a term. Term is for a term, a period of time. You get a term policy, it may last for a year, it may last for 5 years, it may last for 10 years, 20 years, 30 years, but it ends up expiring at some point. Usually when you're a little bit old and it's harder to get, a policy that's cost effective. So term was you can buy a bigger amount and it's less expensive, so it's good for those numbers where you're trying to replace income. You might be trying to replace 3 years of income for, your $80,000 salary. 80 times 3, that's a big number. So you want to put that into term, and at that point, once you 20 years down the road, you've got some investments, you go like, I don't need that anymore, and get rid of it. Same with your debt. You're going to buy your house, put 15-year note on it, 20-year, 30-year note, pay it off a couple of years early because you start doing that funky stuff with the mortgage. That is all going to be gone in a number of years. So term is the perfect vehicle to do that with, because you will most likely outlive it. It's just to protect you in case, or protect your family in case something happens to you. But your final expense, it needs to be there until you die. And so if you're not going to die before the end of a term, you don't know when you're going to die. You might die early, you might die late. You might be 100 years old, 120, 110. You could be pretty old. And if you're going to be, in that category, and the average person is living longer, you want to make sure that that's permanent life insurance, something that will be there when you pass to take care of that final expense, or at the very least, maybe if you live 40 years and the prices go skyrocketing, you might not have enough to pay for the whole thing, but at least you'll have something to hand over to your kids. The other thing, the endowment or education, that can be a term. If you're saving for college and your kids are young, and you get to that 20-year mark and they're going off to college, and you took out the loans, you paid out of savings, you don't need that anymore. Um, you can convert that to a permanent policy for an endowment, or if it is an endowment to start with, you'll want a permanent policy, and those can take a lot of different shapes. Um, for example, let's say you are middle age, you've got 10 grand in the bank, you don't need it, your income's still coming in, you're going to work another 15, 20 years, and you want that money to go to your church, but your church doesn't need it right now. You can take that 10 grand, you can put it in a life insurance policy. And as a middle aged person who's healthy, you can get, $30,000 sometimes worth of permanent life insurance and never pay on again. It's called a single premium policy. And those single premium policies are great for magnifying your benefit to the church or whatever organization. It could be, like I said, NPR or one of these other nonprofits that you're wanting to support. So there you have it. You can take the LIFE test and go through it and put down L, all your liabilities. What do you owe? I, income. F, final expenses. And then that E is either education for young kids, or it's going to be that endowment. It might be zeros on this page. You might, you might not want to leave anybody anything in terms of an endowment. You might not want to let your kids off the hook for fundraising for their own education. That's fine. The point is that you go through the process, you figure out what you actually need, and then you buy that amount of life insurance. And talk to a real live agent. Doing it online, you're going to get a screwed up um, conceptual product, and it won't be what you need. Or if it is, it'll be just because sometimes a blind squirrel still gets a nut. You've got to talk to a real person who's been educated in this, understands the ins and outs, and can advise you. You might not take their advice completely, but at least you'll hear the truth from them about which types of policies to get and how much to get. So that's it. Don't buy too much, but buy enough. Life insurance is too important to skip. You've got to make sure that you have secured for those that you love what is necessary to take care of business after you're gone. The larger your estate is, the more complex it is, the more you need a real agent to talk to and walk through these steps and processes. Don't be afraid of talking to a life insurance agent. We're nice people. We're not going to bend your arm and make you buy anything that you don't want. It's important to have these conversations. I also suggest that you have the agent, you write down all of your rationale for the amounts that you have. Write down why you said you wanted this much, why you wanted this much in permanent life insurance, and why you wanted this much in term. Leave it with the agent, have him put it in your files so that if anything happens, your spouse, when you're gone, can look at that and say, oh, this is what we were thinking when that happens. All right. I hope this makes insurance suck a little less for you. Everybody out there, have a great day. We'll talk to you again soon.